Familiar with Charles Dow? Know the difference between your spot, forwards, and futures markets? Want to start scalping but get looked at funny when you say it in public? This is part 2 of the Basics of Forex Trading. Welcome to part 2 of the Basics of Forex Trading video. I'm Simon. Let's keep up the momentum from part 1 and take the next steps towards becoming a successful Forex trader. In this video, we'll look at the 3 types of currency markets: the spot, forwards, and futures markets, looking exactly at how to use them to extract profits and protect capital. Depending on the services provided by your broker, you should have access to all of these markets. After, I'll introduce the 3 main trading styles and how the one you choose should depend on your account size, commitment to real-time market watching, and your long-term goals. Once we're done there, I'll finish with a short chat about the importance of the trend in Forex trading. Still learning the basics? Our team at FX Empire have your back. Subscribe for regular education Forex content. Let's have a look at some more vital lessons all Forex beginners need to be remembering. 1. Spot, forwards, and futures markets are where you want to be trading currencies. These markets are your bread and butter. Learn them well, and they'll take care of you. But be careful. Wild beasts, there's no taming them. 2. The positions you open can last a mere few seconds to a whacking few years. Trading comes in many forms, all of which have their own pros and cons. The only question you need to ask yourself is, are you a tortoise, hare, or something in between? 3. Higher or lower trends will inform most of your Forex trading strategies. Understanding this simple yet proven trend is key to getting hold of the Forex markets. 4. It's not just higher and lower. Trends and counter-trends can be subdivided and vary in length from super short to generational trends. The original trend model was designed by Charles Dow over 100 years ago and is still used today. Now, let's get on to the main bulk of this video, the market you're looking to trade in. Traders, you can take risks in 3 types of Forex markets: the spot market, the forwards market, and the futures market. The spot market is the most popular, with traders around the world exchanging real assets through an electronic communications network, broker-dealing desks, contracts for difference, or interbank systems. Prices on the spot market are based on the circle of supply and demand. The forwards market is a more sophisticated venue, one that's accessed by international companies and large investors seeking to hedge currency risk. For example, McDonald's might enter into forwards contracts to lower the risk of exchange rate fluctuations and price shocks in other parts of the world. The parties involved in a forwards contract agree on a price they're both happy with. So if McDonald's wants to pay $1,200 for beef in 3 months, and the German farmers want €1,000 for that beef in 3 months, they can both agree on those prices now, regardless of how the exchange rate changes in 3 months' time. The futures market was the most popular Forex market before retail Forex brokers appeared. Futures contracts are based on standard sizes and settlement dates, and are conducted on the Chicago Mercantile Exchange, CME, and regulated by the National Futures Association, all within the USA. Smaller exchanges in other countries also offer currency futures contracts, where the contract determines delivery, settlement dates, and the minimum price increments, while the counterparty would act as the exchange. There are 3 main strategies that most retail Forex traders follow to some degree or another. They are scalping, day trading, and swing or position trading. Scalping and day trading are 2 of the most aggressive and active trading styles. The first, scalping, is a technique that takes advantage of very small movements. If you know what scalping is, then just take that and apply it to market movements. Scalpers try to buy and sell within seconds or minutes of opening a position. A scalper will try and analyze the short-term charts and analyze 1 to 5 minute price. High transaction costs eat up returns with this high-volume trading strategy, requiring high win-to-loss ratios to take home consistent profits. Day trading focuses on 5-minute to hourly charts and, as a general rule, looks for directional impulses lasting from 1 to 6 hours. Occasionally, day traders will take home a position, holding it overnight while seeking greater profits or an important move at the start of the next session. In both cases, scalping and day trading close positions pretty quickly after opening, but differ in trade frequency and holding period. Swing trading is a longer-term technique where positions held for days, weeks, and even months. Now, you gotta remember the order type you're using will also change depending on which strategy you choose. For example, scalpers use market orders more than swing traders because they let them enter and exit positions instantly. Limit orders, on the other hand, are more useful for day and swing traders because positions can be taken at predetermined prices. Stop losses are also used far more by day and swing traders to limit losses in case the market bolts the other way. The trend is an important aspect of trading Forex. Well, it's important for a Forex trader to keep a close eye on interest rates and current events, relying on technical analysis to evaluate major trends and make trading decisions is one of the classical cornerstones of a successful trader. These cornerstones rest on three basic assumptions. First, prices discount everything. Second, history tends to repeat itself. And third, prices move in trends. The majority of newcomers think prices only go up or down, but Dow Theory asserts there are actually three trends in the market: up, down, or sideways, or range-bound. According to Charles Dow's work more than 100 years ago, traders need to look at the sequence of highs and lows to determine a trend's long and short-term direction. Specifically, an uptrend is generated by higher highs and higher lows, while a downtrend is generated by lower highs and lower lows. Then, when neither buyers nor sellers have control of the market, prices evolve within a lateral consolidation, normally referred to as a trading range. The theory categorizes relationships between trends in different time frames, which may converge with each other or diverge from each other. According to Dow, each trend is formed by three other trends: primary, secondary, and minor. A primary trend lasts more than a year and signals a bull or bear market. Within a primary trend, a secondary trend goes in the other direction, carving a pullback lasting between 3 weeks and 3 months. Finally, minor price action is common within the secondary trend, lasting less than 3 weeks. Traders have refined Dow's brilliant trend observations over the last century. We now understand, in our fast-moving modern electronic markets, that primary, secondary, and minor trends can evolve over days and weeks rather than months or years. Even scalpers use Dow's work when flipping positions, using 1 to 5 minute charts to determine the primary trend. Market participants can take Forex exposure through a variety of cash and derivatives markets, but most trade in a cash market through a Forex or contracts for difference broker. Most Forex traders speculate on currency prices through time and trend-based strategies, which include scalping, day trading, and swing trading. The majority of Forex trading falls in between these extremes, with positions open from a mere few seconds, scalping some tasty pips, to opening huge long-term positions, watching huge swings in prices due to unforeseen political and environmental events. Did you take something useful from this video? Let us know in the comments what you think, and if we missed anything. Subscribe for more educational Forex content, and drop a like if you learned something. It helps us out a lot. See you in part 3, 7 common trading mistakes to avoid. Stay strong out there, traders.